Hello everyone, my name is Anjani Kumar Khetan, and in this week video, we will continue to deliberate on lack of exchangeability, which is a recent amendment to Ind AS 21 and IAS 21. Now, if you recall that in the last week's video, I introduced you to the two-step approach which have been introduced by the amendment. So here is the two-step approach. This slide we have dealt with in the last week's session. In case you have not got a chance to look at the last week's video, at the bottom of this slide, you have the QR code and you can easily go and access the video on my channel. Now our focus primarily would be to deep dive into step 1 of the recent amendment to the standards. Now, if you remember, we just did discuss that step 1 basically deals with the moot question whether the currency is exchangeable into another currency or not. So we introduce you to this concept, currency A, currency B, whether that is exchangeable or not. And the paragraph which deals with this determination is paragraph 8, 8A and 8B of the standard. So here, our focus is to ascertain whether the currency is exchangeable. Let's say currency A is exchangeable into another currency B at the measurement date for a specified purpose. Now, these are the key characteristics or the parameters that need to be evaluated. And our focus today, as I mentioned, would be to look at this particular requirement of the standard. So the moot question is, what is the meaning of exchangeable, which is this? When would you say that the currency is exchangeable in another currency? And also, are there any factors? Are there any evaluation criteria which have been given in the standard wherein one can really apply those guidances? We will see all of that yes, there have been additional guidances which have been inserted in the amended standard. So moot question, what do we mean by exchangeable? Now, if you look at the amended paragraph 8 of the standard, it says there are 4 subparts to the evaluation criteria of what is exchangeable. So, under the amended standard, a currency is considered to be exchangeable into another currency when the entity is able to obtain that other currency within a particular time frame which allows for normal administrative delay through market mechanism or any other exchange mechanism in which the exchange transaction between the two currency would create enforceable rights and obligations. So there is a lot going on here. So we need to dissect and deep dive into what these individual requirements translate into. Apart from that, we should also look at paragraph 8A and 8B. So this paragraph, if you look at paragraph 8A, it says exchangeability of a currency. So for example, the example which we saw in the last session, that euro, the parent in Europe was trying to assess whether euro is exchangeable into Bolivar, the Venezuelan currency. So exchangeability of a currency is assessed at the measurement date. So for example, if 31st of March 2025 is the date of measurement, is the date when you are, let us say, translating, for example, foreign operations financial statements into your own, parents, into the parents' financial statement, then on this measurement date, that is 31st of March 2025, when you are bringing in the trial balances of the foreign operation and incorporating into your own financial statements. So the exchangeability has to be assessed on the measurement date, and the assessment has to be with reference to for the specified purpose for which the exchangeability is needed. Now, also I gave you an example in the last session: import of medical supplies versus payment of dividend, or capital goods, import of capital goods. Now, there may be circumstances where, because of the exchange controls placed in a particular country, let's say Venezuela in our example which we have been continuing, now there the import of medical supplies might be permitted, but payment of dividend may not be permitted, or it is permitted only within certain limits. So paragraph 8A says that when you are assessing whether, in our example, whether euro is exchangeable into Bolivar, you got to look at and assess this exchangeability at the measurement date for the purpose for which you are looking at that exchangeability. Is it, let us say, for payment of dividend or import of capital goods? Or is it for a permitted purpose like import of medical supplies? Of course, we will deal with it in more granular details in this session, and also in the next video we will deep dive into various case studies to explain these concepts. Now, apart from that, paragraph 8b, it also says that a currency is not exchangeable. In our case, Bolivar. Bolivar, in our case, is not exchangeable into euro, another currency, if the entity is able to obtain, the parent entity is able to obtain, in our example, no more than an insignificant amount of the other currency at the measurement date for the specified purpose. There is a lot going on, lot of parts and subparts are there. So if you try to relate this with the situation which we portrayed, that from a European parent perspective, whether Bolivar is exchangeable into euro or not, in terms of paragraph 8b, should be assessed by looking at whether the currency is exchangeable if the entity is able to obtain no more than an insignificant amount. Now, no more than an insignificant simply means basically only an insignificant amount. This is a typical way of European English. But then, for all simplistic purpose, you should read this. That means if the entity is able to obtain only an insignificant amount of the other currency, it is not exchangeable, right, for the specified purpose at the measurement date. Now, we will first look at a case study to explain these 2 points, paragraph 8a and 8b. We will first look at the case study, and then we will deep dive into these requirements. We will see in the next section. So first, we will look at a case study, followed by a deep dive into what these 4 boxes basically mean in the context of the amended standard. So let us first see the case study. So in this case, assume similar scenario which we just portrayed. Consider a scenario wherein Citicorp, which is based in Venezuela and has Bolivar as its functional currency, has 2 things. It has 2 items on the balance sheet, these 2. So this Citicorp has a long-term foreign currency borrowings, which is denominated in euro. Bolivar is the functional currency. It has a foreign currency loan denominated into euro, and apart from that, it also has a trade payable, which is also denominated in euro, and this trade payable arises on account of import of, say, electronic goods. So these are 2 outstanding or 2 items on the balance sheet of the Citicorp, which is operating in Venezuela with Bolivar as the functional currency. Now what happens on 31st of December? Assuming 31st December is the measurement date, or let us say the year-end date, the carrying amount, for these 2 items, what is the carrying amount in their balance sheet? The carrying amount of Citicorp's liabilities, these 2 liabilities, denominated in euro, is as follows. When it comes to the trade payables, this trade payable arising on account of import of electronic goods, it has a euro outstanding of 10,000, And when it comes to the foreign currency borrowing denominated in euro, the outstanding amount is 1 million euro. Now, with this fact, the additional fact given in this case study is that the government authority or the relevant authority in Venezuela allows entities to obtain the foreign currency euro with the below cap. That means there is a maximum ceiling up to which the local company, in our example Citicorp, will be able to convert those into euro. So for import of electronic goods, there is a cap of up to 1 lakh euro per annum. That is the maximum amount permitted. Now, if you look at even otherwise also, in this case study, it is given total imports during the year by Citicorp for the purpose of this import of electronic goods is 70,000, which is still below the threshold of permitted by the authorities of $1 lakh per annum. Now, though you have 1 million euro of the outstanding foreign currency borrowings, the authorities permit only up to euro 50,000 per annum with respect to, let us say, repayment of the borrowings or the foreign currency loans. Now, the question is, in this case, if Citicorp is trying to determine the exchangeability of Bolivar with respect to euro, they need to really look at both these aspects separately. So therefore, in this case, Citicorp will be required to assess the exchangeability of euro against the Bolivar separately for these two, because the purposes are different. In this case, there are two purposes. One is making payment to the creditors to the extent of 10,000 euro, and the other purpose is the repayment of potential foreign currency borrowing, which is euro 1 million in this case. So with that said, how it will all boil down to whether and how the Citicorp should apply the amended requirements of Ind AS 21 and IAS 21. So in this case, Citicorp may assess that it is able to obtain sufficient euro to settle its trade payables. Why so? Because the limit is up to 1 lakh euro per annum and the outstanding amount is 10,000 out of the permitted overall total import of 70,000. So when it comes to trade payables, yes, in this case, it will assess that it has the ability to obtain sufficient euro to settle and discharge its liability. Since the amount of euro required, considering the imports during the year 2024 in this case, and the closing position is within the annual limits which is permitted by the authorities. However, when it comes to the other one, foreign currency borrowing, it will need to assess that it is able to obtain only an insignificant amount of euro, because 50,000 as a percentage of 1 million is a very insignificant amount. So therefore, here, considering that for the second purpose, entity Citicorp is able to obtain only an insignificant amount for the foreign currency. Therefore, for this second purpose, the currencies are not exchangeable. So therefore, the Citicorp will assess that it is able to obtain no more than an insignificant amount of euro, because it is able to obtain only 50,000 euro against its liability of euro 1 million. That means for the second purpose, the exchangeability does not exist, but for this purpose, exchangeability does exist. Therefore, for this item, they will apply the normal requirements under Ind AS 21 and IAS 21. That means they will restate these trade payables or translate it at the closing exchange rate between Bolivar and euro at the measurement date, which is 31st of December 2024. However, considering that second purpose is something which they cannot achieve, there is lack of exchangeability, and therefore whatever is the amended requirements under the standard is something which Citicorp need to apply when it comes to the second purpose. So therefore, Citicorp will be required to apply the recent amendments to these two standards, Ind AS 21 and IAS 21 from an IFRS perspective, this is from an Ind AS perspective, to estimate the spot exchange rate on this date, which is estimating spot rate is, if you remember, is step 2, which we will deep dive in subsequent videos, which I already kind of introduced you in the last week. And even in today's first slide, we just recap that. So to estimate, the entity will be required to estimate the spot exchange rate on the measurement date, 31st of December 24, for translating the long-term foreign currency borrowing denominated in euro into the functional currency Bolivar. The balance of trade payable will continue to be translated using the regular requirement, that means the closing exchange rate between euro and the Bolivar. Now, having seen this case study, now let us look at when we saw in the previous slide here, when we said that paragraph 8, it says that for the purpose of the assessing the exchangeability, you got to look at these 4 parameters. For these aspects, you need to look at. Are there any guidance? Are there any factors which the standard has allowed us or has given us that will facilitate how one need to evaluate whether the currency is exchangeable or not? So let us now get into deep dive into step 1 to assess whether the two currencies are exchangeable or not. What parameters, what factors the new amendment tells you to look at, and with the help of that, assessment need to be done. So this guidance is available in the application guidance Appendix A. Now what it says? That when you are determining whether the currency is exchangeable or not, you need to assess, which we have already seen, assess exchangeability between the two currencies at the measurement date, and to evaluate whether the currencies are exchangeable or not, an entity need to consider 5 factors. We will go one by one each of these factors. So the first factor is, which is covered in paragraph A3 in the application guidance. It says you got to look at the time frame within which an entity can obtain the other currency. So for example, if you have currency A and currency B, in our example, euro and Bolivar, you got to look at the first factor is what is the time frame within which these two currency can be obtained. Now, if you remember, I have already explained in the last video that under Ind AS 21 and IAS 21 from an IFRS perspective, spot exchange rate means the exchange rate for immediate delivery. Now, immediate delivery does not mean immediately the day you are buying, because each geography, spot transactions, term, and then cash, each of those foreign currency transactions have its own trade practices. And therefore, the amendment clarifies that the notion of this immediate delivery, which spot exchange rate basically envisages, the amendment clarifies that the notion for immediate delivery for such spot exchange rate incorporates into itself a short period of time to meet administrative, legal, or regulatory requirements in exchanging currency based on the market practices, based on the regulatory environment in which the entity operates. So for example, when, let us say, if the spot transaction entails 2 or 3 days, for example, of the delay, that means you enter into a transaction today, the settlement happens within next 2-3 days. So that is a normal administrative delay that is permitted under the standard. That means if you have a scenario like this, that you have entered into a transaction today and there is some amount of the time which goes from the time you enter into the transaction for exchange of the two currencies and the actual day when the exchangeability happens or the exchange happens, that is something which is permitted. That means that time lag would not indicate that the currencies are not exchangeable. And what is normal administrative delay will depend upon facts and circumstances, let's say the regulatory framework and the practices followed in a particular geography. And therefore, normal administrative delay is permitted under the amended standard. This is one of the factors. So one factor is that you have to look at what is the time gap within which exchangeability is accomplished. Second point, paragraph A4 says that when you are assessing whether the two currencies are exchangeable or not, you only have to look at the ability and not the intention or the decision which the entity has made. You have to look at the ability of that entity to obtain the currency by way of exchange from another currency. So it is only the ability and not the intention or the actual decision whether they will actually do the conversion or not. As long as the entity has the ability to enter into a valid enforceable transaction and exchange one currency into another, it is deemed that this particular factor is satisfied. That means exchangeability does exist as long as entity has the ability to exchange one currency with another. Now, this exchangeability need not be direct. It could be indirect also. So, for example, if you have, let us see this further, currency LC is the local currency. Currency LC, if you have a local currency, is exchangeable into US dollar either directly. That means, so for example, INR is the local currency. Okay. Now, if you go to the authorized dealer, you can just convert INR into dollar. This is a direct conversion. The other option could be, let us say, even if the direct conversion is not available, even if there is an indirect conversion available, that would also meet this test. What does it mean? It simply means, let's say, directly you can't convert INR to dollar. For example, let's say you can though convert INR and let's say pound. You can convert it. And then you can convert pound into dollar. So this is like a cross rate or the indirect conversion. Both, if you are able to convert the currency into another, either directly or indirectly, this ability test is met. So that's, now you read it. Currency LC, in our example INR, is exchangeable into foreign currency USD if the entity is able either to exchange local currency INR for that foreign currency USD. That is the direct exchange. Or, second point, let us see this. Or, exchange local currency INR into another currency, say Euro, which I said GBP in my example, and then exchange that GBP or Euro involved into USD. So, direct or indirect, both, either of that would satisfy this ability test for the exchangeability of the two currencies. Now, the third factor, which is given in the amended standard, is paragraph A5. It says, when you are assessing the exchangeability between the two currencies, you have to look at the exchangeability only and only in market mechanism or some other mechanism for conversion, which results in enforceable rights and obligations in the eyes of the law. So, if you look at the amendment clarifies that when assessing whether a currency is exchangeable into another, Bolivar into Euro, when you are assessing that, entity will consider only such market mechanism or exchange mechanism in which the transaction to exchange these two currencies would create enforceable rights and obligations. And of course, that would depend upon the facts and circumstances. So you may have the regular market, official market, and you may have unofficial parallel market. So when you are assessing the exchangeability, you have to look at either both or only one of them, which is the official market, depending upon whether if you transact in this particular market, which is parallel or unofficial market, will it lead to enforceable rights and obligations? If it does, then perhaps you will consider this also. But if this market does not create enforceable rights and obligations, then exchangeability in this market will not be factored in. So the amendment basically tells you that exchangeability, when you are in step 1, and we will see this change when we go to step 2, you will see the relaxation. But when it comes to step number 1, the requirement is very simple, that for step 1, you have to look at only those market mechanism or other mechanism which results in enforceable rights and obligations. So if enforceability in the eyes of the law is not something which is happening in a particular exchange mechanism, then that need to be ignored for the purpose of step 1, exchangeability between the two currencies. The fourth paragraph, or the fourth parameter, fourth factor given is paragraph A6. It says, currency is exchangeable for the specified purpose. The example which I gave, medical supplies versus import of capital goods, that needs to be assessed. The exchangeability should be for the purpose which you are looking at. Even in the last case study, we saw that for the foreign currency loan, exchangeability did not exist, right? So, but for trade payables, it did exist, right? So that thing, the purpose also need to be assessed. So in some jurisdiction, some currencies have different exchange rate that might apply for different uses. For example, different rates for import of capital goods versus import of other goods and services, not the capital goods. Medical supplies versus any other import. Different rates might apply in a particular currency, in a particular country, if those regulations do allow. And in this case, the moment you have more than one exchange rate or you have exchange rate for various different purposes, different exchange rates, this would affect the entity's ability to obtain those currencies and thus would lead to lack of exchangeability. Exactly same example which we saw in the last slide as well. That for foreign currency borrowing, for that purpose, you don't have the exchangeability. But for your trade payable repayment, you have, right? So that is what this particular point says. And therefore, it would be important for the entity to consider the purpose. And that's what this point says. The purpose for which it is required to obtain the other currency. This chart also tells you the same what we just discussed. Earlier also, medical supplies, yes, it is exchangeable. Dividend distribution, perhaps not there, based on the regulatory framework in the particular country because of the exchange issues which they are facing. And the last evaluation point, which is given in paragraph A10, is that when an entity is assessing the exchangeability between the two currencies, they need to look at the ability to obtain, again what we saw, that no more than an insignificant amount of the currency. That means that the amendment considers that the currency is not exchangeable if not more than an insignificant amount can be obtained. That means if only an insignificant amount of currency can be obtained for a particular purpose, like the example which you gave in the last slide for foreign currency borrowings, where you have the balance of 1 million euro, whereas only 50,000 euro was permitted as per the local regulations. So in that case, for this purpose, you are able to obtain only an insignificant amount, and therefore this test would not meet. Now, obviously, this approach, which we are saying, it is consistent with the other requirements in Ind AS and IFRS in fair value measurement, Ind AS 113, wherein it says, if you look at this approach is similar. Let me clear this. So this approach, what is being mentioned here, is similar to the approach in Ind AS 113. When volume or the level of activity for an asset or liability has significantly come down. So if the market activity comes down within the context of Ind AS 113 fair value measurement, then an entity may depart from using an unadjusted observable price. This is permitted under Ind AS 113, and similar piece is also given here. Okay, so this is what I wanted to cover for this particular video. Now, of course, we will have for each of these factors which we have on the slide, or almost all of them, we will have illustrative examples explaining each one of them in the next week's video. We will take case studies and thrash each one of them out so that you have a crystal clear understanding of how do you eventually apply step 1. And these illustrative examples is something which is also there in the illustrative examples in the in IAS 21. So we will leverage those examples and pick up each one of these points, and this is what we will be discussing in the next week's video. So the series will continue. In that, next week we'll be focusing again on case studies on step 1, and the next to next week's video we will look at step 2 and the illustrative examples related to step 2, and that would complete our entire discussion on this amendment. Of course, now I'm just trying to split the video so that it doesn't become too long for all of us to pay attention, and that's why I will take a pause here, stop it for today's deliberation. Of course, as mentioned earlier, this is the QR code for my YouTube channel. Please do subscribe. If you think that it is something which is useful, you can share with anybody who's in need of this kind of a video. Any type of this help which you give to the channel will always be appreciated and will be very, very helpful. Okay. So with this, I take a pause and we will continue to remain engaged. Bye for now. Thank you. Take care.